With over 13 years of asset management expertise, my guest today on the show has advised over $3.5 billion of equity investments in India alone. Please welcome Swanand Kelkar, ED of Morgan Stanley Investment Management. Swanand Kelkar, pleasure having you. This has been a long-awaited interaction. In your own terms, if you ask a layman, it wouldn't really be the politically right thing to ask, but how's your performance been, and is there performance anxiety now as we step further into 2018?
That's an interesting question first up, but I'll put it
You're used to it.
Yeah, I'll put it this way, that every fund manager should be able to clearly articulate what his or her investing style is. You cannot be everything to everybody, right? You should have a certain style of investing, and you should also be able to say what kind of environment, a market environment, will your style underperform in. And you can do this in good times, which is the best way to communicate this, that these are the market environments in which our funds don't do well. So what are the market environments in which we don't do well? So if you think about market returns as a bell curve, right, which has got two tails, the two tails being less than 20% market returns in a year and maybe a 30% plus. So red hot bull markets or really batten down the hatches kind of bear markets. Those are the two ends of the bell curve in which our portfolios don't do well. Right.
And where are we currently at in that bell curve?
I think from the period, let's say I would say October till January, we were getting on to the really red hot bull market type phase, which is where we started losing a bit of performance. Now I think we are coming back again towards the median on that bell curve from October onwards, from January onwards, February, March, etc. And I think our portfolios have started doing well again. Having said that, I think performance is coming back, which is
so there's no anxiety on that.
No, I mean, you never had an anxiety. I mean, if you can do this in good times, you can, I mean, that is one of the important things that every portfolio manager should do, is to prepare himself or herself in advance. That these are the environments I'm not going to do well, which helps you deal with the stress and the anxiety much better.
So what are the dots connecting to? Because, up until January, it was all gung-ho, and then came LTCG, Trump started tweeting, that's how our life begins every morning. You've got crude now at 72. You're a little worried about the RBI changing its stance, not just RBI, but across the globe. You're a little worried that money is getting expensive. You don't know how the geopolitical scene is going to be. Back home, you've got a 2019 election, and given the spate of the last few state elections, you're a little worried about on that front. It's not going to be as smooth a sailing as 2013-14 was. Are the dots connecting to you not reaching that one end danger zone? Are we still somewhere in the middle, or are you a little worried about what the prospects are leading up to?
So I'll tell you the context or the setting in which we are operating, right? I mean, there are three elements to it. I mean, I'll talk about it separately. One is the macro, one is what's happening on the ground on the micro side, and then there is politics, which you alluded to. So if you look at the macro from 2013 on till middle of 2017, it's been a one-way macro improvement for India. And if you look at the three main indicators which showed you that, one was the current account deficit. We were $90 billion. We came down to 15 in 2017. So the big correction from 5% of GDP down to less than 1%. The fiscal deficit came down in a big way, and the current account deficit, the fiscal deficit, and of course inflation. The CPI was running in double digits for most part of 2010, 11, 12, came off. So that was a big macro improvement which lasted till I would say middle end of 2017, and that's what the view we took around September of last year, that India is now experiencing peak macro. And what do we mean by peak macro? That macro is not going to improve from here. The macro might at best stabilize, and we hope it doesn't deteriorate. So the current account deficit this year will print around $50 billion. Last year was 15. The fiscal deficit is actually going to increase this year, not alarmingly, but at least the trajectory is going to be different. And inflation, as you rightly said, people are now getting a bit more worried about the inflation specter. So I think people have become very watchful on the macro, which brings me to the micro. So on the micro, I think there is almost clear consensus now that growth is picking up. Right? I mean, if you look at a lot of high frequency indicators, you can see that most parts growth is looking much better than it was, let's say, 2 to 3 years ago, and that will probably reflect through into earnings of companies as well. So a macro which was doing great for the past 3-4 years, now at stabilizing or turning down a bit. The micro which was insipid for the past few years, now looking up. So you have to think about the interplay between these two things, right? It's kind of a tug of war between these two, and what wins will decide the market direction, right? If the narrative from 12 months now is that the current account deficit is at 80, oil is at 80, 90, no matter of earnings growth will help revive the markets or help markets help take markets much further. But if things stabilize over here on the macro standpoint and the micro looks up, then we can have good returns on the market. So I think it's an interesting juncture we are at, and I'll keep watching the external vulnerability that I talked of. So politics is another curveball. So on the next 12 months probably are going to be politically very busy. The way we operate, we have historically looked through phases of political volatility, right? India thankfully has is a rich stock picking ground. You have many stocks out there which have outperformed or done really well in different market environments under different regimes, not only macroeconomic regimes but also political regimes. And I think we place our faith, or we make our bets on those stocks rather than focus and worry too much about what the political outcomes are going to be.
On that note, we're going to take our first break. We've identified the symptoms, but what are the hacks? How can we work around the current macro and micro situation? We'll analyze that after this quick break. For opportunities between the macro and the micros, how do you juxtapose the two? How is it that you find that trough?
So I'll tell you one thing which I've learned as an investor, and learned it possibly the hard way. When I have bought stocks in the portfolio purely betting on the macro, the results have been far from optimal. Which means, to give you an example, if you end up buying an exporter just because you have a view on the currency, that does not get you great investing results, because you also need to spend time analyzing what that exporter does and where do the exports happen. So there is excitement, let's say, about information technology today, right? Because it is an exporting sector. The rupee has gone from 63 to 66. I cannot find at least the broad sector growing for the next few years double digit in terms of top line. If I can't get that conviction, buying information technology just because it benefits from currency weakness, I think is a very weak rationale. I don't think you should do that. Just buy a macro trade. Let me buy exporters.
So have you stayed away from IT?
Yeah, we are underweight on information technology. We continue to remain that way. We've been underweight now for a fairly long time, and it's a very simple yardstick. It's a very simple filter that we use. Can I convince myself that this is a 12 to 15% earnings growth story for the next 2 or 3 years, right? I have to think really hard to get that conviction on IT. You might get 1, 2, 3 tech names, smaller ones maybe, who can meet that growth barrier. I mean, I'm very clear that I'm investing in India for growth. I'm not investing in India for yield, right? I mean, some of the tech stocks are also peddled today as yield plays. Clearly not interested. The macro, and this is my favorite analogy, the macro is like the pitch on which you bat on, right? You have to, at the end of the day, still make runs, right? But the macro decides what kind of shots you play. The macro decides what kind of shots you avoid. And is run making easy, is run making difficult, is depending on the macro. But I think to make runs at the end of the day, that's really important. And I think about that. It just lays the context for stock picking. It is not entirely what the stock picking is all about.
And the index has never been your pitch, if I'm correct. It's always been about individual stocks. And considering how skewed you are and the large exposure that you have in your portfolio towards banks, it's a little surprising as to how you've been so selective and so concentrated within just private banks. And within private banks, I'm tempted to ask, are there any corporate banks in there? And if there are you repenting it? So the financials weight, as you rightly picked it up, is all private sector for us. Yeah. We do not own any SOE banks. We have a few NBFCs. On the corporate bank side, here is a judgment that we made, and I think the big call on the corporate bank side was what happens to the asset quality cycle. I think the remaining stuff, at least on the private corporate banks, is fairly straightforward. On the asset quality, we thought there are 3 legs to how an asset quality cycle pans out. First is you get a lot of slippages when new accounts start slipping. That's the beginning of the asset quality cycle. These accounts start aging, which means that you have to now provide more and more for these because they have remained on your books for a while. And the third stage where things start coming out, where you start getting some sort of resolutions
on these.
So we're at that third stage.
So I think the first stage is done, right? Yeah. I don't think in the past 12 months you have heard of a new big account slipping. There have been cases of frauds, I understand, but a new account slipping because of economic factors is not happening.
Yeah.
Right? We are somewhere in stage 2, where now you are being made to provide more and more for those assets. You are towards the end of that stage 2. I mean, you could not call it by any 4-letter alphabet that you called it earlier. You have to now call it what it is and provide for it, right? So the problem has been ring fenced. I know these are the 5-10 guys who are stressed. Now I need to decide whether they carry 30% provision or a 50% provision, which analytically is easier, right? I know what this is. Because everybody is now moved to adjusted book value, right? You might provide what you want, but I am going to provide 80% and adjust book value accordingly. Yeah. So that is where we are. And we are now seeing some glimmer on the third phase, which is resolution, right? We are seeing some cases come out. I mean, it's only last week that we had one resolution happen. So we thought that we are towards this part of the cycle where the problem has been identified. It needs to be fully provided for, and there is a semblance of things coming out on the other side, which is why we own corporate banks in the portfolio. Now, what's happened in the meanwhile is there have been non-fundamental factors which have affected some of these things, right, which are related to more
core fundamentals.
Yeah, exactly. Yeah. More than core fundamentals. But what we are doing for now is we are sticking with the fundamental view that this is the asset quality cycle which is playing out.
The underlying story.
The underlying asset quality cycle is playing out this way for now. But as Kane said, if facts change, you will change opinions.
Okay. So what about NBFCs? What about HFCs? What about insurance? Why is it that you've stayed aloof, or not aloof, maybe just dabbled a little bit here and there? So why aren't you convinced about that story?
So on NBFCs, we have been very selective, and the framework that we have used is to think about NBFC like a commodity, right? There are two elements to a commodity. One is either you have extremely cheap raw material, which is you have iron ore in your backyard. Nobody can then make steel cheaper than you because you have iron ore lying next door, or you make such products that only you make, and therefore you can command pricing, right? And then you can buy iron ore from wherever you want. We thought about financials in the same context. Either you have great low cost deposits with you at 4% in the form of CASA, in which case nobody can compete with you on what you sell, right? The iron ore is lying in your backyard, right? It's very cheap. Or you lend in a space where you are pretty much the only organized lender, or there are very few organized people, in which case you can dictate price, right? You need to have one of the two. If you have both, I mean, that's very rare to have. But if you have one of the two, then you can be a sustainable story. Some of the HFCs were neither, right? They could not compete with the private sector banks on the cost of deposits, and they were doing Me Too lending. So that is the space I'm happy to engage in. I mean, either show me that you sell products which nobody else does and hence have pricing power, or show me the iron ore in your backyard. If you can't do either, not interested. On insurance, which you asked, we have stayed away from insurance companies, although we believe in the fact that financialization of savings is happening.
Yeah.
Which has been a trend talked about quite a lot for the past 18 months. But we have opted to play it a bit differently through, we own a wealth manager, a private sector wealth manager. We own an AMC in our portfolio. So those are the kind of names that we have gravitated towards, rather than towards insurance, where I frankly, I mean, I must admit this, I have struggled a bit understanding valuations there.
You're not alone.
Yeah. So I've struggled a bit. So I mean, you do rather. So Buffett has this great thing, right? There's this box called Too Hard, where you just don't understand what's happening. I mean, you need not have a stock, do not have a view on every stock and sector in the market, right? I mean, I have put insurance companies in the Too Hard box. Guy invests in a SIP for 12 months and has zero returns to show for it at the end of it. He doesn't care that Indians have only 4% of their equity in households. He's looking more for his relative.
He wants his return.
Exactly, right? So does that person then move to fixed income? Does that person again dabble with property? Does that person again go to gold? I don't know. I think this is the point at which it might get tested. When the market returns are, I wouldn't call bad, but middling. Does the SIP flow of $1 billion plus month?
Test,
yeah, I think it's a good time to see the strength of that trend. My gut feel is that that trend will continue, maybe not as roaringly as it has done in the past few months, but I think it'll continue. And this is based on interactions I have with my private banker friends, with people on the street, people who do SIPs. I mean, there are people in my office who haven't been equity investors, who have opted to be first-time equity investors through the SIP route, which I find is a very different conversation I have than, let's say, in 2007-8, when everybody used to ask me, is this an IPO I should put money in?
That frenzy is far from
exactly. So I think this time around it's better. It's
a more sensible frenzy, if you can call it that.
Exactly. And I'm hoping that this trend continues.
You know, which brings me to what you said when you were on the channel last time, the aspirational Indian, and you take cues for investing a lot from this aspirational Indian. So what is this aspirational Indian telling you about your investments? Where is it that you need to tap into pockets?
So the aspirational consumption is something that we got in early. I mean, we have always preferred the consumer discretionary space versus consumer staples. And the good part about it is that we live this every day. I mean, if you just compare what you are spending money on 20 years ago versus today, it will tell you what stocks to own in the portfolio, right? I mean, I have watched movies in theaters where the acoustics were really bad. There was a lag between what the actor used to say on screen and what you used to hear in terms of the dialogue. You had rats for company. The food was really bad. I mean, that is gone. I mean, now you go into a multiplex, which is...
You want the popcorn, you want the Coke, the works.
Exactly. So that's changed, right? And you're not reading this in any consulting report. You are living this...
Yeah, you're experiencing
living this every day, right? So, and that's where you take your cues from. I mean...
we're a minuscule part of the population.
Sure, right? Absolutely. Absolutely. But this thing is now percolating to...
Penetrating to tier
more and more
and
places.
Tier 3s too.
Which I find very interesting. The other trend which I have picked up of late, I mean, just being around, I mean, I saw 2 hoardings on shops very close to my office. The first one said loan pay phone, which means that you can buy a phone with a loan. You can pay an EMI on the loan. And right next to it was a DSA of a company, and it said phone pay loan, which means that you can get a loan on a phone. You can get your credit score.
That easy to get.
You can get credit score appraised, and you can get a score. So loan pay phone pay loan, next to each other, I think is a trend that can go for the next 3-4 years, where the Indian household levers itself up. So the household leverage in India is very low. Household debt to GDP is fairly low, and there is, I think, there is a generational shift in attitude which is happening. My parents, very debt averse. Debt was a bad word. You cannot have debt. They bought all their assets, whatever meager assets they had in terms of the house, from their own savings and pooling from friends and family. I see the millennials in the family. I asked them one of
first taking the loan and then deciding what to do with
absolutely.
it.
Absolutely. I think the generational shift in attitude is happening, which will show in the debt to GDP. So it's very simple, right? What do you buy? You buy people who are giving them loans and doing it sensibly, and you look for what these people are buying. They are buying phones, they are buying cars, they are buying bikes, they are buying discretionary items like accessories, fashion, etc. So both those are great pools to think of. I mean, think about people just doing it sensibly, and you know what to have in the portfolio.
The other leg then, CVs, I recall, is something that you were extremely bullish on. Hopefully, it should be a good monsoon for a 3rd year consecutive. Opportunities still, or has one missed the bus already?
No, I think the CV cycle we have played for the past 3-4 years. It's a deeply cyclical sector. But again, what we have done is a bit counterintuitive. We have sat through the past 3-4 years in certain CV stocks that we own. So the cycle was in one way. So some of the private sector banks are what I call are clockwork compounders, right? Every quarter, they give the same numbers. These, I think, are also compounders, but they are compounders over 3-4 years of time, but go through a cycle within those 3-4 years, right? And CVs we have stuck through, I think, it still has steam. I mean, if you look at the volume numbers coming out on a monthly basis, it's doing really well. If the economy is picking up, which it seems to be, I think CVs will do well. It's a derivative play on the economy, especially the heavy side, the mining and things like that. I think commercial vehicles will keep doing well. And in India, it's still pretty much a duopoly. So you don't get those industry characteristics in a lot of places, right? The Indian autos, I think it's very interesting, where you have a consumer car company with a market share in excess of 50%.
So that's CVs, that's PVs. What about two-wheelers? Because that's where the tier 2, tier 3 aspirational Indian, that's what they want to ride, a fancy bike, right? That's
Absolutely.
where it all starts.
I think it's the same trend of aspirational consumption, right? I mean, what is it that you wanted in your college going years, couldn't afford, but are now buying it? So there was a brand of two-wheelers which was very aspirational, always been there, could never afford it, never buy it. I think they have got their act together. I think they are doing really well. I think that the trend there is that from a cookie cutter kind of a bike, you want something which you feel good about. I think that shift is happening, and that's there in numbers as well. So the bike takes you from place A to place B, and the other bike
you want to up the coolness quotient.
Exactly, you want to be a bit macho, up the coolness quotient, whatever you want to call it. And I think that's where again it's aspiration. It's nothing different. So the cheapest bike in India would be $600-700, but you are willing to pay $2,500-3,000 because you want to exude that coolness. So we own some two-wheeler stocks in the portfolio.
Where are the new hunting grounds? This is all that you've already owned.
Absolutely. So agreed. So so what have we done in the past few months in terms of changes to the portfolio? We have gotten a bit more constructive on healthcare. And that is again we have bifurcated the healthcare space, and we are not getting into companies which have exposure to the US, right? Because that market is still deflating in terms of pricing, the generics pricing. But there are enough stories which are domestic in nature, which again are doing reasonably well. So that is one place that we have added to domestic healthcare, and that's just not.
This is medicines, not hospitals, right?
This is medicines primarily, not hospitals, but we are looking at diagnostic companies, hospital companies. I mean, these are definitely being evaluated for investment, and we have added some there. The other theme that we have played in the portfolio is gas utilities, that we feel very strongly about. That there is not only an economic logic, but also a regulatory push towards. I mean, if you are in Delhi,
greener,
exactly. If you're in Delhi, it makes sense now to drive your car on gas. I mean, it makes clean economic logic versus petrol versus diesel.
Yeah, see the mile-long queues outside a CNG petrol pump as opposed to
and plus you get the benefit on an odd even day if it comes through, because CNG based cars are allowed. So there is an economic logic, there is a regulatory push. I think this combination is good. So we are playing some of the gas utility names. We added to one of them.
You're not worried that they've already run up so much?
They have, yeah. I mean, if you look at the chart price, if you look at the charts, they have run up. Yeah. But on a valuation basis, they still are not in insane zip codes.
Okay.
They are still within reasonable zip codes. So the one argument which is the negative argument, is that these are utilities. These need to trade like utilities and at a certain PE and PB. The other argument is these are like staple companies, and these should hence trade as staples. So I think the truth lies somewhere in the middle, which is where they are. And I think if they can keep delivering the 15-20%, we come back to that 15-20% type growth, I think they'll keep chugging along well. The one theme which is being talked about, which we haven't been very convinced on, is private capex recovery. I don't see any signs of it happening as of now. But again, this is data driven. So if we see data picking up on the government side, there are pockets where spending is happening. We
That's
know about
roads,
that. Yeah, we know about that. But on the private side, I don't see much as of now, be it in the CMI numbers or be it in the RBI numbers that come out. But that is something we are watching, that at some point in time this has to inflect. So if the economy does well, consumption is doing well, capacity utilizations go up, that is when a fresh capex cycle starts. So those are some of the pockets we are evaluating.
No metals?
Metals we have kind of stayed away from, because making the price call there has been a bit out of our league, because it's a very global commodity. We have cement stocks in the portfolio. Those are material stocks. But on the commodity side, we have just been a bit cautious, because we are not really sure that this is a multi-year
bull run
like the 2003 to 2007. Of the lot, something that I'm evaluating a bit is maybe steel, because there's a domestic story going there about capacity and the supply side, right, which is consolidating supply, and could that be an interesting dynamic to look at? I mean, Russia would privatize its largest aluminium producer. I mean,
are you not worried that you're slightly late in the day evaluating steel right now?
Maybe. I mean, that's fine. I mean, if I can convince myself that this runs for 3 years, I mean, so be it. I mean, that's happened with a lot of private banks for us. And it's also saved us from a lot of promised turnaround stories. That if you wait for a couple of prints, you're fine. You're buying the stock 20-25% higher, but you can also save the portfolio from a lot of duds. by waiting for those couple of prints. So yeah, you're right, the stocks have done really well, but that is something I'm happy to evaluate. If I can convince myself this is something I can hold for 2 to 3 years at least, I'll dabble in it.
So for the remainder of 2018, 9 months to be precise, if I'm looking at that one foolproof idea or sector in your case where I'll make about 20-25% returns from the current levels, what's that one solid sector that you'd recommend?
Private banks.
Private banks. The top ones.
Yeah, I think
obviously.
I think it's fairly easy, right? I mean, here is an industry setup where 2/3 of the industry does not have growth as its top priority, which is the SOE banks, right? So there is 1/3 of the industry which has reasonably clean asset quality for most part, can focus on growth. So growth is not a challenge because 2/3 of the economy, 2/3 of the industry is not doing much. And if you have maintained asset quality thus far, right, you haven't had an asset quality problem thus far, I think it is reasonable to assume that you wouldn't have a big corporate asset quality problem creeping up in the next few months and quarters. The risk reward is still in your favor of having a decent compounder and still being able to sleep at night.
Peacefully. Great speaking with you.
Excellent.
Thank you so much
Thanks for your time.
taking time and speaking with us.